Hey everyone, welcome to another edition of our Smart Investing Stock Analysis, where we take a closer look at companies on a fundamental basis that may have hit the news, that may be good buying opportunities. Maybe they're just popular and overpriced, and maybe we think we're a sell. But today we're going to take a closer look at a little-known company called Target. Target hit some big news last week. Stock fell about 25% in a single day. They missed earnings very, very drastically. I mean, gosh, you look at the numbers here. They were expecting to make $3.07 a share. They came in at $2.19 a share. So quite a miss there. Kind of surprised by this, though. Sales, they did beat. They came in at $25.2 billion, while the estimate was for $24.49 billion. Target really pointed to, the supply chain as a big issue, rising freight costs due to energy costs. Those are really hitting the bottom line for a company like Target now. Could be a reason why we saw such a big difference between the sales estimates and the earnings estimates, where their costs did outpace their sales due to, again, a lot of the inflation that they're incurring on their cost inputs. Now, kind of broadly speaking here, thought it was very interesting. We've talked a lot about this already, where I think the companies here that are going to succeed going forward are going to be more of the experiential companies. Now, some of their stocks may have gotten too expensive, but Target did allude to the fact that the consumer does actually remain quite strong, but they've really kind of shifted their buying habits. Instead of buying things like, electronics and TVs, they were buying toys for birthday parties, luggage for trips. So the consumer is not weak, which is something that does give me some comfort going forward here for the economy. And again, for those of you that don't tune in regularly, I continue to believe that the economy will be strong enough to get through the remainder of this year without a recession. I do question next year, just because there is so much money out there in the economy that's still circulating around. And I think that the shift to service spending after being locked down for a couple of years there is going to carry us through the next year. Now, what does this do for the stock market? A lot of people talking about the stock market crash, what's going to happen there and so forth. Well, we have seen a big pullback in the NASDAQ, but a lot of great companies out there may have now become buying opportunities. And there's other companies too that haven't really crashed, so to speak, down about 20, 30%, like a lot of those big tech names or something like Netflix down 70%. But there's a lot of names out there in retail that are actually doing, I'm going to say, quite well. And you're seeing this dichotomy in retail of, some retailers doing really well and other retailers struggling. I think you may miss the boat on some retailers. Like I know Williams-Sonoma reported a great quarter. I think they've gotten too pricey. But, a company like Target, even a company like Walmart, they've kind of struggled as of late. There could be some buying opportunities there. So I do want to take a closer look here at Target. As always, we want to take a closer look at the numbers, the financials behind the business. That's what drives our decision-making process, not, again, following the hype or the excitement of the stock market. We're looking at the numbers here for Target. Again, ticker symbol is TGT. You see here just 2.1% is considered short at this point as the percentage of float. Institutional ownership about 81%. Looking here, the last report date was 1/31/22, so we are going to be needing to see new numbers here shortly, but it could give us some good guidance as to maybe why the stock did fall so much. You see price to earnings now at 13.8. That is very positive considering the industry average is at 26.9. Price to sales at 0.8. Well, that's the same as the industry average of 0.8. Price to book, that is slightly higher than the industry average, is 7.2 versus 6.2. But price to tangible book at 7.2, also well below the industry average 22, tells me that company does not have anything in intangible assets. That is a big benefit as an investor there. Looking at price to cash flow, it's at 13.3, lower than the industry average of 19.4, and a forward PEG ratio of 0.8, very attractive considering the industry average is 4.9. Overall, these valuation ratios look, I'm going to say, pretty darn good. Looking at the growth rates, see earnings growth over the last 1 year up 15.1%, the same as the industry, and sales go up 8%, and the industry was down 0.9%. So that's a big positive. And going forward, the 5-year estimated earnings growth at 19.6, I'd like to see that number there. Get a good dividend with Target at about 2.2%, and the company only uses 22.2% of their earnings to pay that out. Tells me it's a very safe dividend. And I'm going to say it's a pretty darn good yield as well. Company has bought back a lot of stock with a buyback yield of 9.5%. Now, turning to the balance sheet, I see a current ratio of 1, tells me they have a good amount of liquidity there. Debt to equity at 130%, got higher than the industry and starting to kind of brush up against an uncomfortable point for me. At 130%, I'm by no means worried about this company going bankrupt or anything in the short term, but I would not like to see any more addition of debt to that balance sheet. That could be a warning sign, something I'd want to understand further and really keep a close eye on as well. Turn to the profit margin, you see 6.6%, better than the industry average of 3.3%. Return on equity, 54.2%. And then return on invested capital, also very strong at 25%. And see here the current price, $167.14. Well, look at the 52-week high, $268.98. Big fall from that high level there. And the low, $145.51. Again, that was achieved last week, I believe, after the bad quarter that they reported. See, it has bounced back a little bit since then as other retailers have reported some strength this week. We see year-to-date stocks down 27.2%. Over the last 1 year, now down 25%. We see our longer-term returns are still quite strong for Target. Now going forward, again, that target sale price I got to January 2024, I do see estimated earnings per share of $13.51. That would give us a target sale price of $224.27. So that's a big positive. I mean, there's a lot of things to like with Target here. The valuations are strong. They're still looking for growth as well. One thing that I will say that kind of caution people on is I do want to try and find companies that can really raise prices and have an effective strategy in increasing prices to offset the inflation that they're incurring on the cost side. I do believe that the branded retailers, I'm not saying these are buys, but companies like Michael Kors or Nescafé Holdings or, a company like Nike or Adidas, they're the brand names there. They go directly to the consumer. I think that they're going to have a little bit more pricing power. I'm going to feel a little bit safer in those names. But one thing I will say with Target is I do believe they have their own branded products in their stores as well. I'd be very curious how much of their inventory and how much of their sales comes from their own brand there. That could be, I think, a very, very strong buy if that is the case, because I think they're still, again, looking to grow earnings. And now you're getting this retailer that's on sale. Before, it was way too expensive. Now this could be a great buying opportunity for a great company. And I know they're a big benefactor from COVID. And I think a lot of that demand got pulled forward and that was reflected in the stock price, but now that's adjusted. So I'd say do a little bit more research, but overall, I like the numbers on Target. I liked the brand. I think there's some good opportunities there. Thanks for joining me today. And as always, if you found the video informative, be sure to hit that subscribe button below. And just as a reminder, this video is not for financial advice. It should not be used for financial advice for that matter. It's just for informational purposes. If you'd like more information about our investment firm, Wilsey Asset Management, go to our website, smartinvesting2000.com. Again, that's smartinvesting2000.com.